the commercial advance payment will not exceed 15% of the contract price. So it's going to be 15% of the total, which is what the total amount is that they're allowed to give you for a commercial item. Contract is awarded competitively, and the CO obtains concurrent. So they have to be in sync with their own payment office to ensure this goes okay. A couple different methods they can do. They can give you advance payment. So they'll, before you've completed a certain portion of the work, they can give you money as an advance payment against what they're going to totally owe you. They can give you progress payments. So we can say that I'll give you, even though you haven't fully developed a solution, when you get this part done, this milestone will give you 15% of the total. When you get this milestone done, we'll give you another 10%, etc. They can do loan guarantees by the Federal Reserve banks for contracts related to national defense, so that's something that's just on the DoD side of the house. They can give you partial payments for acceptance. So let's say, for example, they want you to provide 1,000 widgets, and you're like, okay, we're a small company, we're doing this as fast as we can, but instead of waiting for us to get all 1,000, then can we give you 100, and you pay us for those, and we give you another 100, so that you can keep your money, your cash flow coming in, so that you can pay for raw materials to buy the next group and so on. And then any kind of performance-based contracts, performance-based payments like we talked about before, all those would be considered government financing. How do they pay you? What you want to do is get yourself set up in, I think they call it CCH, and it's basically the clearinghouse, contractor clearinghouse. So you give them all your bank information, and then they will make electronic funds transfer directly to your account. They also have these government-wide purchase cards we talked about yesterday, and then payment by a third party, where they have a third party making any payments for the government. Some work that you do, particularly in the construction area, would require bonds. So basically, the Miller Act mandates performance and payment bonds for all construction contracts over $150,000, unless the requirement is waived in the best interest of the government. So they have to go through, in order to require a bond, they basically look at similar requirements across the government, and did those require bonds, and if so, they probably will require a bond for this one. Different types of performance of bonds. Bonds as to whether or not you perform, or if you fail to perform, then the money kicks in. Annual performance payment bond, that you'll receive payment. If you receive payment, that you'll be able to pay back. Advance payment bond, we'll just talk about those. Any kind of patent infringement bond, are you using someone else's patent, and is the government liable for that? And finally, a combination of all the different types of bonds. So sometimes they'll do like a hybrid bond that includes several of those categories. So there's a part of the government evaluation where they look at, they call it responsibility. Are you a responsible contractor? So they're going to pull your Dun & Bradstreet report. They're going to pull, they could pull your, ask you for your report or your profit and loss statement, those kind of things. Basically what they're trying to do is determine if you're financially able to take on this contract. So they'll look at auditors, Small Business Administration, any kind of other sources like banks, underwriting information. This is all to determine whether or not they should require a bond from you. Just like when you think about the criminal justice system, you know, is this person considered a flight risk? If the answer is yes, then they require a big bond, right? If the answer is no, then they don't require a bond. So it's the same kind of thing with you. Are you financially capable to handle this work? In which case they may say, no, we may not need a bond from you. But again, this is all for construction. They have to evaluate the contractor's responsibility, which is what we just talked about. You know, what's their production, what's their past performance, and then whether or not the company actually needs it. Okay. All right, why don't we take a 10-minute break and we'll pick back up.